Thank you very much, and thank you all for joining us this afternoon. For those of you who don't know me, my name is Beeston. I'm the founder and managing partner of Illuminate Financial Management. We're a purely financial markets technology-focused fintech VC, i.e. we invest in fintech that is aimed at financial markets participants, or enterprise tech that is aimed at financial markets participants. I'm just going to set the scene for a couple of minutes before I introduce or ask our panelists to introduce themselves. I established Illuminate in 2014 because I believe that we are at a moment of generational change within financial markets. Interestingly, I don't think that's technology driven. I think it's everything to do with the macro operating environment. I think it's a function of industry deleveraging post the crisis, massive multi-jurisdictional regulation, and an effective transition into a zero-tolerance compliance environment. To me, that meant a huge chunk of the technology stack and the infrastructure stack that supports financial markets businesses today is either no longer fit for purpose or in the process of being rendered no longer fit for purpose. Before I ask the panelists to introduce themselves, I think it's worth kind of noting that what we've actually got here is a group of pioneers who've built businesses across a period of 3 years through to over 25 years, and each addresses those industry challenges in their own way. So I'm going to go to Alex on my left here and ask him to introduce himself and his company and where they sit in the market structure space.
Hi, I'm the founder and CEO of TNG FinTech Group. TNG stands for the next generation. We wanted to provide the next generation of financial inclusions or financial services to the unbanked populations around the world, because there are more than 2 billion people are still unbanked today, almost half of the world's population. So obviously our target are not the people in this room, but perhaps is the domestic helper working for you at home. So we are quite well known, and we are the youngest, I believe, among a few panelists here. We just turned 3 years old. We started from 0 merchant, 0 users, and we just turned 3 years old. This year, we generated more than 20 billion US in transaction volume, especially on the cross-border side. So this is a very exciting time that we see in terms of global financial transformation, not only to the well-banked individuals, but the biggest impact we see is the growth sector is on the unbanked in providing the financial inclusions to the global unbanked populations.
Thank you. Kim?
Yeah, my name is Kim Fournais. I'm the founder and CEO of Saxo Bank, which I founded more than 26 years ago. So in that sense, I believe I'm the oldest here. Whilst we are a bank, we don't lend out money. We are 100% focused on being a facilitator in global capital markets. I think what makes Saxo Bank special is the fact that we cater for all financial products and asset classes, so stocks, bonds, foreign exchange, equities, both on a cash basis as well as derivatives. We offer this in more than 25 languages and really cater directly both for traders and investors. And then we also work with wholesale partners, other financial institutions or fintechs or others that needs access to global financial markets. And we really deliver what we call banking as a service. So we support the full value chain. So really kind of deliver a bank in the box trading global capital markets. It's obviously been a very interesting journey. We started, as I said, more than 26 years ago, pretty much on a shoestring with 70,000 euros in capital. And actually, we never got any funding or anything like that. So it's been a special journey until now. And it's also now that really our business model, I would say, is maturing, because the model we have now is the same as back in the late 90s. So I think it's fair to say that we were definitely fintech and regtech even before the term was even coined. So thank you for being here.
Okay, thank you, Kim. And Richard?
Hi, I'm Richard representing M-DAQ. The word M-DAQ stands for multi-denomination automated quotation. It's quite a mouthful. But that's also explaining our very first product some 9 years back, when we were setting out trying to create a world without currency borders, but specifically in the vertical of international securities trading. So focusing really on that space, on how you can buy, sell, and trade and track your securities trading in the currency of your portfolio. But 3 years back, we pivoted into e-commerce because we found out that there was a hypothesis that we needed to test, which is price certainty leads to a commitment in transaction, something that was unproven. So we decided to pivot and move into enabling cross-border e-commerce platform to be able to buy and sell with multiple currency, but with price certainty. We wanted to test, and with that particular product, we have turned full year profitable for the first time this year. So that's a quite important milestone for us, and we hope to carry on trying to pursue our dream, which is creating a world without currency borders. Thank you.
Thank you very much. And Shailesh.
Thank you. My name is Shailesh. I'm the founder and CEO of MatchMove. We're positioned as a wallet operating system so that if anyone wants to provide essential wallet services inside an existing app, we can provide it. Two specific differentiators. Number one, we are a wallet factory. We're of the view that there are going to be hundreds, if not thousands, of wallets all floating around the world and all of them interoperable. Number one. Number two, we don't believe that the wallet wars will be won by just a few big names, you know, if I can say a few, Paytm, Alipay, etc. In fact, we are proving that many, many large corporate brands want to have their own full-featured wallet. Today we have about 50 organizations. We have about 150 in discussion. These include airlines, remittance companies, transportation companies, retail chains, all of whom are saying, I want control of the payment experience, I want control of the data. So what MatchMove has is an operating system that allows what we call banking as a service, very basic banking as a service. We call it spend, send, and lend. Spend my money anywhere I want, send my money wherever I want, and lend and borrow when I want to. We've packaged that up, put it into an OS, delivered it as a platform, and I'll end off just with a metaphor and analogy for you. If you go into many countries, if you walk into a retail chain or a convenience store, you'll often find an ATM in the corner of a retail chain. And you can go to that ATM and do essential banking. You can check your balance, you can do all kinds of stuff. Take a step back. Think about a big mall that you've walked into recently. Malls have bank branches inside. So we're talking about a physical location where you go to, where at some level you can do basic banking. All of those physical stores and services are going onto mobile. Imagine if you could put a bank in any app. That's what MatchMove does. We put a bank in any app at all. Social, mobile, e-commerce, transportation, airlines, etc., etc. We're across 7 countries. We're not as big as my friend Alex yet in terms of volumes, but we're confident of hitting a $1 billion, US $1 billion run rate this year.
Thank you. So without further ado, we'll move on to the questions. And the underlying premise here is, how do fintech pioneers stay relevant amidst challenges from both the fintechs coming through below them and the traditional financial institutions, which I think is quite an interesting perspective of being caught in a pincer movement between two types of competitor. We see about 120 to 150 new emerging fintechs a quarter just in our B2B section of late seed and Series A. We go all the way through to what one consultant I know calls legacy fintechs, i.e., I think those are just vendors by any other name, and all the way through to financial institutions. And I'm gonna come to you first, Ken, because you sit in a very interesting seat here. In a world today where you are either being disrupted or you're doing the disrupting, how are you handling that pincer movements from the young emerging challenger technologies and the established community?
Well, I think first of all, this is an evolving ecosystem, and what technology has done what the whole, the global macro trends of globalization, changed consumer behavior, technology with mobile and so forth, the whole regulatory landscape, new business models, the constant pressure on margins. It just means that no one can do everything for everyone everywhere. It's going to be certain death. So it's really about finding partnerships and understanding also which battles you can win. And the battles where you can win, you may be able to win today, but only if you constantly improve. And that also means that you have to always be aware that there will be areas where unless you improve or change your business model completely, you will be obsolete. In Saxo Bank's canteen, we have a big tyrannosaur, so a big old dinosaur, so we can remind ourselves every day that if we do not constantly improve, we will get obsolete. And that also means that there may be business areas or opportunities where we've been making good money for a period of time, but if we can see that that's actually going to be challenged by a better model, we'd like to be the first ones implementing it, right? Because otherwise it's just you're going to have a much bigger problem at some point. So we have since the beginning been extremely partnership oriented. We are still, so if we can partner with someone who can help us create a better client experience, we will. So for us, it's about having an optimal client experience with the lowest possible cost and complexity in a very scalable manner. And then it doesn't really matter how we get to that point, because you can only do that by being really agile, open-minded, and work in strong partnerships.
Thank you, Kim. Alex, do you have anything on that?
Yeah, we can share a few things. When we first started 3 years ago, we have less than 30 people. Now we have close to 500 people with a footprint across 14 countries. So we went through a very rapid transformation and growth. If you notice on my name card, there is no title. None of the people in our company have any title because we constantly shifting and changing our strategy. And we have many teams to discuss about what we did last week and how do we improve this week. And small improvement each and every week. So basically, we adopt the same strategy or DNA. We should always look for ways to obsolete ourselves. If we don't obsolete ourselves, we will be obsoleted by our competitors or bigger competitors or someone with deeper pocket. And we got to grow through API. Very similar DNA, like Kim just said. In the future, a few years from now, you don't conduct your banking transaction by going to the retail outlets of the traditional bank. And very soon, you don't conduct your banking transaction by going through the online banking platform. You conduct your banking transaction or carry out your banking transaction through third-party applications. So this is happening as we speak, and we can't do it alone. We have to do it and open out our API and in massive collaboration with partners around the world so that we can really create and to be the best we can be. We can't be everything ourselves. We have to work with partners to achieve that.
Well, I think that kind of takes us into the partner question. And Richard, I know your business model probably depends quite heavily on that. So perhaps you can talk a little bit about how you're partnering in the community.
Because for M-DAQ, we are not just a B2B play, but at the same time, we are quite close in terms of the upstream to the source of what our product, which is foreign exchange. And having come from that side of the foreign exchange side of the bank, we are quite aware that, firstly, FX is very opaque to many people, whether it's businesses or the actual customer user. And at the same time, FX suffers from certain toxic flow that's introduced to the system by entities who trade based on latency arbitrage, price arbitrage, model trading. But the whole market is sometimes expected to pay for the toxicity in the system. So the 2% that introduced the toxic flow, 100% of the market may have to pay for that. It's a bit like an insurance premium. Those of us who have car insurance and suddenly next day it goes up, I say I wasn't involved in an accident, but there were pockets of people who did that, and maybe on a very large scale basis, everyone else is going to suffer. So from the onset, we decided to try to achieve two things, which is to make transparency a cornerstone, and as well as to separate the liquidity pool so that we do not engage in the same space as hedge funds or black box trading. We try to bring FX out of East Coast, bring it to the West Coast, metaphorically, and so that we can apply it to payments, remittance, e-commerce, stock trading as a second derivative. So by doing that, we are able to create more transparency, better pricing. But at the same time, we realize that the banks are our partners. So if we can make sure that our banking partners are able to retain their sustainability in the ecosystem, so there's no overfeeding, then this will always lead to more trust in the ecosystem and brings about better pricing transparency for all. So this is something that we value a lot in terms of the partnership. So in a way, we do not disrupt, but we try to separate the liquidity pool into two.
Okay, Shailesh, anything you'd like to add?
Well, I'll just endorse what's been said. We can't run our business without partnerships. It is absolutely essential. The question is, what is a partnership? Are we going to make a joint announcement together? Or are we actually going to get into the nuts and bolts, jointly make money, but also provide a better service than would have been possible alone? So for us, MatchMove, in terms of our delivery to the ultimate end user, there are probably 10, 15 key partnerships that are essential for us. And partnership sounds better than vendor, but it's really about having skin in the game as both partners. If the partners have skin in the game, it comes together. So partnerships essential, but there's different nuances to partnerships, and ultimately you have to have the right ones and keep making more and more. If I can just add quickly to the earlier question about how to stay relevant. We actually, I never think about that in the sense that I'm assuming there are hundreds of new barbarians at the gate, just like we were barbarians when we turned up at the gates of the banks. And I fully expect that there are people in this room who are looking at 5 of us on stage and saying, how am I going to get better, faster, cheaper than that guy? We welcome that. We think ultimately that's good for the industry, as long as we can do what we're supposed to do, focus and deliver like crazy. That's how we'll stay relevant.
Kim, you had another point?
I just wanted to add one thing because, again, this is an evolving ecosystem, and I think there's a very simple rule for partnerships, which is it needs to be win-win. And when it's win-win for the clients, it's win-win for the people that deliver solutions, it's long-term sustainable. And then, of course, the organism may change and so forth, but I think really it's about finding other people or companies where you can create win-win to the benefit of your clients. And I think that makes it very simple to discuss and determine how to take it forward. But I think that's the essence. So again, rather than talking competition and barbarians and so forth, I think it's really thinking partnerships, because no one can do everything for everyone.
Yeah. I think, to be fair, we could have saved everybody in the room about 50 minutes if we just invited them into the conversation we had before we came out, because when you put 4 entrepreneurs like this in a room together, entrepreneurial things start happening pretty quickly. So maybe watch this space. That, I guess, brings us to the question of innovation. It seems that every day there's a new innovation lab opening up. Many of the legacy vendors and the traditional financial institutions have their labs. They have them all the way from the financial centers to the West Coast, heads of innovation. I'd be interested in getting your individual perspectives on that. Well, there are no titles in your organization, Alex, so I know you haven't got a head of innovation. How do you think about that and what's going on there?
This is a bit premature. Since you asked me that question, we have our own lab under renovation in Hong Kong. 2 locations, combined 40,000 square foot. So we wanted to open out our more than 3,000 APIs, banking APIs, to our partners. And the lab, we call it the Wall Street Factory. The great launching pad for the launching pad for the great entrepreneur. So we wanted to provide the space, we wanted to provide technical support for the FinTech, RegTech, InsurTech companies to tap into our open API to build their global platform, to serve their global clients. This way we can grow a lot faster. By helping them to be successful, we also can benefit from it. And Hong Kong will be the first point, and we are looking at some other countries as well to cultivate this. And we invite the bank to take advantage of our lab and to build and develop this ecosystem. I call this building global ecosystem, that everyone got to be win-win and we all can be successful together.
Perfect. Kim, sorry, go on.
I just wanted to say that I think a lot of people talk about innovation and technology, which is very important, but I think it really starts with culture and with leadership, because you know, the legacy banks who sets up innovation labs and so forth, I think they lack the culture, they lack the leadership. And also many times when you have fintechs that are doing something really, really great, you cannot integrate it into the legacy technology of a major bank. And I think in the end, if you have the culture and you have the ideas and you constantly pursue to constantly improve the Saxo experience or the client experience, well, then you will have innovation. You will always figure out how you can drive better solutions for the clients. But that needs to start with a different point, because if you just have technology, you have innovation, it does not necessarily fit into an organization on the technology stack. So I actually think sometimes it's a good idea to take a step back, and then ideas come. If you always think about how you can create a better client experience and everyone thinks about that, you will innovate.
I mean, a general observation that I would make is that the word culture does not come up anywhere near often enough, but true harnessing innovation absolutely starts at the top. But then you still have the founder running your firm, so that might be a bit different for some of the legacy financial institutions.
Can I just add to that, please? So, you know, we putting a big sign saying innovation center isn't going to do anything except a waste of money, in my opinion. Innovation doesn't happen because, you know, a bank decides, oh, we need to look sexier and smarter, so we need to have something called innovation. And to your point, you know, everyone's been announcing innovation centers. Take a walk and walk around some of those after, you know, it's all the shiny stuff is done and the free coffee is done. Talk to some of the people and find out how they feel about it, number one, and number two, what's actually happened in the last 6 to 9 months. I have yet to see an innovation center set up by a bank or a financial institution that's really produced stuff compared to a 5-man startup. And that, I think, comes to the culture. It's a bit like me, you know, I'm overweight, so I go and put an Apple Watch on and I think, okay, I'm innovating now, I'm cool. It's very, very optical in my opinion. I think it's a waste of shareholder money that the banks should be putting somewhere else. I think banks do need to supercharge and recharge their tech capability, but until they deal with all the legacy stuff, it is just lipstick on a bulldog, in my opinion.
I say a few things as well. I've been in and out of different innovation lab when we first started during the first year as a baby, taking baby steps. It was a complete waste of time joining those innovation lab, because the bank doesn't really, they basically try to copy and learn from our ideas, learn from our mistakes, not much of help. You don't see a lot of innovation, or they adopt any or much of the innovation. The intention is to tap into the ideas and learn, that's all.
Just a very brief comment. I think there are many ideas, and most people have ideas. But actually to plan them and execute them is something different. And typically, you know, those new ideas would mean doing business in a new way. So then it ends up being culture again, because you don't want to disrupt or undermine a certain business line or change technology and so forth. So there's a lot of stickiness, because in the end, technology is just an enabler. It's not doing anything in its own right? So I think it's very, very important that when those ideas are there, that the organization is ready to adapt them. And if you kind of say first, well, it cannot cost any money, we cannot build new infrastructure, or we don't want to disrupt our current businesses, well, then you may as well not set up an innovation lab, right?
Yeah, culture and innovation actually goes hand in hand. The one thing I wanted to add on is that for us, we try to make everybody a stakeholder in the future of the company. So with that, there's no safety net. There may be a trampoline, but no safety net. So with that, we actually encourage everyone to take a 20% time, just like Google, except that the 20% time over here is 20% out of 120%. So it's after your work day, you'll be involved in some special activities project. And some of these may eventually happen to become a real product for a real client. Others, we just take it as a learning experience. And one of the ways we try to pass down the DNA or the culture is that as the firm has gone through ups and downs over many years, there will be staff who have already left but have actually created a certain impact in the past. We try to, at every opportunity like offsite, to let them know about the stories that we have gone through, especially those scary ones, so that the rest of them looking at the current situation, thinking we've got a great pantry, everything is there, but once upon a time we had nothing, and how did we get through the wilderness? How did we get through the Death Valley? So those are very important learning lessons, and that encourages everyone to stay hungry.
I guess the real innovation only comes with intense competitions. So as the competition's getting stiffer and stiffer, everyone, not just fintech companies, even the incumbents will also become very innovative.
Yep.
Not through the innovation lab.
Okay, so I'm going to move it on to the build versus buy paradox. Are we building our relevance? Are we buying it? Are we buying it in? I was at a technology conference in Palo Alto a few weeks ago, and it was quite refreshing to hear a CTO of a major bank tell the room that their policy was they only build it if they can't buy it, and they will only build it until they can buy it. Now, whether that's actually true or not, I'm not 100% sure, but it's certainly a very big change in the rhetoric compared to where we were even 3 or 4 years ago. And I'd be interested to know each of your pioneering businesses, how much of that content is authored at the line item. I'm actually going to start with Shailesh, if you don't mind.
So the build or buy for us is always on the table. And for us at MatchMove, it's a very simple question we ask. And that's related to speed. How fast can you get it to market? If somebody else has got it, can do it better than we can, we absolutely will buy it or we'll partner with someone. There is always this thing, of course, when you employ as a tech startup, you're full of engineers who want to build everything. They want to build the world. So the real friction point is not so much at a management level whether we decide to build or buy. It's typically inside the company, our company, when the engineers say, well, screw that, we can build something better. Give me 5 more headcount and I'll go and build it. But the build or buy for us is very simply who can do it faster. But there is a bit of a paradox I want to mention. As a B2B, we don't want our customers to build. We want them to buy from us. So there's always that dichotomy of, going to a big organization and saying, stop pretending you can build this, just buy it from us. But internally, we do use speed as the decision about build or buy.
Yeah. And Kim, you've got a big stack. How are you thinking about that?
I think in the build and buy question, there's kind of a premise that I'm not sure I totally agree with, because I don't think necessarily people will have to either build or buy. I think many things actually comes as a service these days, and I think in the overall ecosystem of how to we're Danish, so we think about Lego, and how you build that ecosystem with Lego bricks could be a service where actually installing software, buying software, integrating software. And for every financial institution to do that, I just don't think is a solution going forward. So I think much more will be a service in the cloud. And I think, honestly, most financial institutions, they are not FinTech, they are not RegTech, they are not global liquidity or product providers, but they have a client franchise. So maybe they should really get a bank in the box, and maybe they shouldn't even consider building or buying, but just getting the service that they need, right? Apart from that, I agree with the CTO in the panel there.
Good. And Richard?
Very often we forgot that it is an ecosystem. We ended up treating it as an ecosystem, right? Because everyone wants to own their tech. Because they say, what is a tech company who don't own your tech? So at some point, many of us may have gone through let's try to build everything, including project management tools, including how we sort out our document, our database, search tools, and so on and so forth. But at some point, we kind of realized that what is core, what is not core. The one that is core, we absolutely cannot outsource it. But whatever else that's not core, we should really partner in a form of an ecosystem. But being able to distinguish between the eco and the ego remains quite a challenge for many entrepreneurs and management.
Alex?
There is no simple answer. I think as a bank or as a financial institutions, we are in the business of trust. So we should safeguard our compliance, safeguard the AML, risk management, so on and so forth. And to the consumer, it is irrelevant what technology they are or we are using. To them is whether they can trust their money with us, whether they can trust our services. So trust is everything, and it's a great asset that we should invest and take very good care of it. Technology-wise, is not too relevant. Like Kim also said, it comes with services and global network. And you cannot buy the network. You can subscribe to the network, and you have to pay a fee for the network for someone who already built that kind of network. And for the interest of time, we rather buy or subscribe to the services rather than build everything ourselves. But we have to spend our resources in self-guiding the asset or the money of our users. And meeting the compliances, meeting the regulatory requirements are the number one priority first, and then followed by consumer protection. Whether we make money or not to the regulators, that is none of their concern, but it is our concern down the line. So, no easy answer, but we'd rather subscribe.
Okay, thank you. I do have a control panel here to allow me to ask questions from the audience. It is, however, not refreshing, so I'm just mentioning that in case one of our organizers in the room can give me one that actually has some questions on it. But before I go there, I just ask one quick question. We've talked about staying relevant. We haven't used the words blockchain. We haven't used the word AI. The word data snuck its way in there. Certainly, we talked a lot about interoperability in the room at the back, and we've talked about APIs, right? I tell my investors all the time, we're a domain solutions investor first and a technology investor second. How do you think about those hype technologies when you're thinking about your relevance? Kim?
Well, I think, again, anyone running a business should start thinking about the client experience, how to reduce cost and complexity, and create scalability. And I think then there may be different enabling technologies for that. There are lots of hype around that. There's no doubt. I mean, right now, I think AI and big data is a hell of a lot more relevant than blockchain in most of the financial industry. So I think it's also about maturity. It's about when that technology can enable, again, the core components of how you run the business, right? I think we're going to see a lot of development, of course, in blockchain, no doubt. And once we have proper standards, it could change the clearing, the custody business. I think right now it doesn't seem that cryptocurrencies are doing that well. And I think the current setup there, I don't believe much in, to be honest. But of course, it has a lot of relevance. But the hyping discussions have a tendency to run it with a lot of people who actually probably don't really understand what it's all about, right? And I think, again, all these technologies should be seen as an enabler, and that's how we should look at it.
Okay, anybody else want to take that?
I would just add that it's, blockchain today, AI tomorrow, it's the tech cycle. There's going to be something else coming around the corner. It's been happening for decades. It will happen. From our point of view as a platform play, we continue to look at each of these and then decide what to incorporate or not. But specifically saying we're doing blockchain or AI, well, we are, but it's not the reason for existence. It's more about, can we adopt them and make our services better?
We invest in AI, ABCD, basically the AI, blockchain, big data, cloud computing, but we don't talk about it because to the consumer, to our customers, it's pretty irrelevant. Whether they can trust the money with us, they can trust our service, and we can meet all the compliances to the regulators are the key. Technology keep changing, whether it is ABCD today or XYZ tomorrow, it doesn't really matter to the consumer or to the customers.
Okay, Richard, I'm going to come to you with the first question from the floor, and I'm going to nest a couple of questions there because we talked about culture, and there's a couple of questions in there about maintaining the vibrancy of the work environment and also about attracting talent. It would be interesting to kind of get your perspective on where the talent's coming from, and as you grow and become more successful, how that startup culture is maintained, or indeed if it's appropriate to maintain it?
I think in the early days when we onboard the talent pool, they tend to be generalists, because at the time we were quite small, 10, 20 people, and you want everyone to be doing 3 jobs. So they have to be a DBA and a DevOps, and by the way, can you do QA as well? And if you can do marketing, great, So those were the early days. But later on, when we have a little bit of scale, you tend to go for the specialists. That means you hire direct into a role. But all of these things, we felt that there's a sort of a common thread. Instead of focusing on the hiring only, which everybody does, we're focusing on the departure. So at the point of departure, we always tell them that you are merely taking a sabbatical. You're going to go out there because the grass on the other side is greener, because we kind of still pay very, very poorly, cash-wise. So they do sometimes need to make ends meet, and they say, I want to cross over the other side. Sometimes I will be tongue-in-cheek to say, well, the fake grass are greener. The real grass tends to be brown. But what we have is actually we have a very clear boomerang policy. The Australian boomerang, we actually say that the day that you come back and join us, we'll award you with a boomerang. We will carve down Act 1, what was the date, followed by Act 2 and maybe Act 3. And so far we've given out 7 boomerang, including 2 double boomerang. So these are the ones that if someone were to leave your company and you essentially say, I hope to see you back again at a point where you're ready or we are ready or your skill sets has already deepened to the level that you can do something else, this actually allows us to continue to have a flow of talent pool coming in. And many of those who have left us continue to feel that they have a vested interest either in some of the options that they still keep or the ones that they feel to be proud of the legacy of the company. So they won't be out there trying to basically put a negative spin to it, but they feel that one day this is something that they can come back to. So we actually have a boomerang policy, something which may be quite unique.
Okay, and Kim, 25 years of running a fintech. Is it beanbags or is it pension policy?
I think if it gets to pension policy, we lost the game for sure, right? I think in the end, it's all about passion, and it's all about feeling that you're part of something that is super interesting. That in the end, time is the only resource we really got. And if we are trying to create win-win, if we are trying to lower the friction in financial services, if we have interesting jobs where people are empowered and they're allowed to do stuff and actually get a responsibility, but also a mandate to do stuff, and they can be proud about what they do, I think passion is the only thing that can keep you going. And I've been here for more than 26 years. I'm still quite passionate, and I think sometimes maybe that's not bad for the rest of the business as well, that they can sense that's still the case.
Okay, I'll move to this risk question. Risk to fintech from cyber and fraud, and how secure the clients are. You're servicing a huge number of clients, Alex, in a huge number of products in a huge number of jurisdictions. How are you thinking about that?
Personally, I'm constantly paranoid. Seriously. Because there is no room for mistake. Again, if you are in the business of trust, and to our unbanked population is hard-earned money. Every time they send money, it's like a life or death situation, or every day is emergency, as I call it. To safeguard their money and to provide reliable services are very, very important. And I constantly fear that there's always a blind spot because we are growing so fast in so many markets and so many countries. How can we better protect our IT infrastructure, our cyber security, and constantly upgrading our compliances, even though the regulator haven't come to us? They do. They're squatting in our office every now and then to go through every... but we engage other consultants or Big Four to look at and study what else or what other holes that we can plug. That, to me, sometimes people don't realize, our partners don't realize, the regulator also don't realize, and certainly our consumer, our customer don't realize. But it's something that we are constantly paranoid about cybersecurity and the protection of our system.
Okay, Shailesh?
So like Alex, we live in fear constantly. We do handle a large number of data for users. It is not just superficial. It goes through KYC, so we know where money comes from, where it goes to, and the bigger we get, the bigger the target we become. The problem is that, in the old days, if you were like a bank, you had to worry about one location, one vault. Now we're sitting on the cloud, and it's really open season for anyone, anywhere. So how do we take care of it? We do everything we can. We look at best practice. We consult with industry experts. Wherever possible, we try to imagine or where necessary, use black hats, white hats. We're constantly on that edge of paranoia. That's the only thing we know how to do, and I think anyone can do. That said, it's not just about what happens. It's also about what happens after, and how you fall and how you bounce back. So again, we do pay a lot of attention to that. To Kim's point, because it's financial services, there's no room for, it's a life and death situation, not just for the user, but for the company. So if there is a failure, you can pretty much consider the company dead as well. So we think about it constantly. I don't think there's a short, easy way out of it.
Okay, let's end with this one. Where are areas where legacy financial infrastructure are replaced or had been replaced, or let's add and might be replaced by fintech challenges? And I'll ask Richard to go first on that.
For instance, the SWIFT rail, which is used by all the banks for transfer of funds, that's clearly something that in the interbank market or large corporate, that's fine. When you start talking about small and micro payments, whether it's e-wallet transaction, remittances, this become actually very expensive on a notional amount basis. So there is a need for it to evolve. And certainly organizations like SWIFT has been listening to the ground, and they have new developments that is coming up that will allow even smaller transactions to take place at a fraction of the original cost, and knowing where your transaction is at any given point in time. So I must say that the incumbents, as well as infrastructure players, are listening, although the speed at which they are doing may not be as fast as what the consumer markets would like to have, but certainly the direction is there.
Kim?
Well, everything we do is banking as a service, so that's really all about getting a service proposition, supporting the full value chain, rather than having the installed legacy software. And again, I think logically anyone can understand that having legacy software in all banks and financial institutions is very costly. Gartner did a survey showing that 80% of CapEx in banks goes to maintaining legacy software and coping with regulatory change, which does not give you opportunities for multi-asset or open API or multi-currency or better mobile solutions and so forth. So I think it's really, the whole model needs to change. And that means it will be cloud-based, it will be shared services, it will have to all change. And that we put on the first partner back in 2001. And have tried to work on that ever since. A good example lately is Banca Generali in Italy. They have 2,000 financial advisors, and they are now we're launching in December with them, where all their financial advisors, all their clients is gonna use our entire value chain, so they can focus on the client franchise and their branding and building that, and we support the rest. I think that's a very good example, I hope.
Okay. Okay, thank you. We're out of time. I'd like you all to join me in thanking our panelists for a very engaging discussion.
Thank you very much once again to Mark and the panelists. Thank you, gentlemen.